So, hello, dear students. Let us start the next session in the course of alternative investments. This session will be devoted to the concept of private capital and all corresponding issues. And let us start with a brief review of your home task. That was the 4 questions quiz from the previous session. So I will switch now to the demonstration of screen. Yep. And we can shortly go through all these probably intensive questions regarding the calculus, but it's not a problem. So your report, your results are pretty good, I should say. On average, it's all 5 or A's mark, so you are good. But let us just walk through the questions. And if you have any problems outstanding, issues outstanding, please raise a hand or type in the chart. We will dive through and I will provide an answer to you. So is it true or false that advantages of funds of hedge funds include a due diligence in selecting individual hedge funds, access to hedge funds that may be close to direct investments, and dilution of returns to the investor? The statement is a false. So as all those 3 attributes are indeed the true of fund of hedge funds, the dilution of returns to the investor is a disadvantage to foreign investors. So please paying attention that each time you have a possible dilution of interest for the investor, it is a disadvantage. Then we have United Capital with 250 million of initial capital, and it's charged the 2 and 20-year scheme management fees based on asset under management at the year end, and 20% is for incentive fee in excess of the hurdle rate of 80%. So we have the first year United appreciated for 16%. Then we have the assumption management fees are calculated using kind of a period valuation, and investors' net return we should calculate, assuming that the performance fee is calculated net of the management fee. So a very straightforward calculation. We have end of the year capital equals 219 million. Then it leads to the management fee of 5.8 million, and a hurdle rate equals 20 million because it's 8% of 250 million. And it leads us to the incentive fee, the base for calculation of incentive fee. So the net increase in a value of the fund net of all the management fee and hurdle rate, and leads us to the 2.84 million. And then we have the total fees for United Capital, it's 8.66, that lead us to the final result of return to the investor of 20% and 0.54. In other words, task is a Capricorn fund of funds with 100 million pounds. We have also that fund of funds invest in each of Alpha hedge fund, that an ABC hedge fund, and Capricorn fund has 1 and 10 fee structure. Management fee and incentive fee are calculated independently at the end of each year. After the first year, the net of their respective management and incentive fee. Capricorn's investment in Alpha is valued 80 million pounds, and in ABC 140 million pounds. The annual return should be closest to one of these figures. Again, calculating the incentive fee, we have end of year valuation of the total investment of 220 that lead us to the management fee of 2.2 million pounds, and incentive fee. You see that the management fee is not extracted from the calculation of incentive fee, and we have incentive fee of 2 million. Total fee is 4.2, and this leads to the final return rate to the investor 7.9. And last, it is the following information that is applied to Rotunda Advisors. So it's a hedge fund with a 288 million in it under management. We have again the same structure, 2 and 20, based on the year value of the assets under management, and we have 5% soft hurdle rate. Means if we get this minimum rate of return, then we can apply our incentive fee on the whole profit. And also we have already achieved the high watermark of 357 million, and also this is a 25% yield for this return. Let us calculate the fees earned by Rotunda. So you have see that the result is a 360 million gross net asset value. Then we have a deduction of incentive fee, and it bring us to the net asset value that is less than the high water mark achieved previously. That means that Rotunda will earn management fee of 7.2 million, but does not earn an incentive fee. So the final answer is 7.2 million. So any questions regarding these calculations, regarding these quizzes, please explain. Your answers are good, and they will be counted as a portion of the score that goes as the homework score. But also we'll have a few quizzes in the next lectures, not in this one, that will be counted also as a homework. Okay, if there is no questions regarding the quiz, let's move to the presentation. So today we will talk about the private capital, that one of my most loved theme, probably because I worked for private equity for a couple of years or even more. So let's start with the overview of the private capital. Private capital is a broad term for funding provided to companies that is not sourced from the public markets, such as proceeds raised from the sales of equities, bonds, and other securities on exchanges, nor from traditional institutional providers such as government or bank. When capital is raised from sources other than public markets and traditional institutions, and it is provided in the form of an equity investment, it is called private equity. If similarly sourced capital is instead extended to companies through a loan or other form of debt, it is referred to as a private debt. So we have two components of this private capital universe: it's private equity companies and private debt companies. But as we will see later, in some cases they are interfering with each other. The private capital looks at the entire capital structure, comprising private equity and private debt. The private capital space largely consists of private investment funds and entities that invest in the equity and debt securities of companies, real estate, or other assets that are privately held. Many private investment firms have private equity and private debt arms. That means it's some subsidiaries of the holding companies. However, these teams typically refrain from investing in the same assets or businesses to avoid overexposure to a single investment and to avoid the conflict of interest that arises from sitting on both sides of the creditor's table. So that was the very case from my experience when I was employed by venture capital boutique of Transmash Holding. So Transmash Holding is the biggest machinery producing company for locomotion in Europe, and it definitely desired to have a limited exposure on any projects that are not in the field of this issue, this industry of producing locomotive. But for example, they want to have some probably synergical solutions like loyalty programs for those who are using locomotives in the suburban transportation, some additional video surveillance solutions for security purposes or any other reasons. And of course, despite this issue of limiting exposure to the core company, also the very nature of private equity is that it often deals with such investments like venture capital that have a very high levels of embedded risk. So also to limit or delimit at least the exposure to various risks from the core company. And if you're using these suburban trains for Moscow region, probably you're already using this passenger loyalty program called Sakvoyage. And you also can see that the locomotives and the carriages that are employed by the central suburban company is also manufactured by Transmash Holding. So the task of having the limited exposure to the same market from various branches of the company are completed, and also all synergy effects that exist when you have the common customer base for both the transportation services and the loyalty program is also completed. So that's a good example of how it can be structured, how it can works. When private investment firms are typically referred to as the private equity firms, even when they have private debt arms. Although private equity is the largest component of private capital, using private equity as a generic term could be less accurate and possibly misleading, because other forms of private alternative finance have grown considerably in size and popularity. So what is the landscape for private companies? So not all private equity is accessible to institutional investors, and many large firms are held by families or founding partners whose shares are simply not available to new investors. Let us consider a few examples of these top companies in a sense of its valuation. We cannot know the market valuation for these companies because they are not marketable, but there is a lot of disclosure materials and a lot of market research and a lot of proprietary valuation papers that can bring us some view about the at least revenue and a possible valuation of this company. So let's start with the Samsung Group. The Samsung Group, we can use to name it simply Samsung. It is South Korean multinational manufacturing conglomerate headquartered in Samsung Town, Seoul. It comprises numerous affiliated businesses, most of them united under Samsung brand, and is the largest South Korean chaebol. If you know this definition, it's a Korean word for business conglomerate. And as of 2018, Samsung has the 8th highest global brand value. Samsung was founded by Lee Byung-chul in 1938 as a trading company, and over the 3 decades, the group diversified into areas including food processing, textile, insurance, securities, retail. Samsung entered electronic industry in the late 60s and the construction and shipbuilding industries in the mid 70s. These areas would drive its subsequent growth. You know, probably all of you, virtually all of you, have a Samsung cell phone or something TV set at some point of your life, or your family should have it. So, but following the death of the founder, Mr. Lee, in 1987, Samsung was separated into 5 business groups: Samsung Group, the holding company, Xingai Group, CG Group, Hansol Group, and Kyunggang Group. So probably when you will come across some report with these names, you should know that is all part of the Samsung Group. And notable Samsung industrial affiliates include Samsung Electronics, Samsung Heavy Industries. It's a second largest shipbuilder in the world. Samsung Engineering and Samsung C&T Corporation. It is again companies in engineering and construction that takes respectively 13th and 36th place in world rank, and also they have some like very diversified fields of interests. You can see that we have Samsung Everland. It is an operator of Everland Resort, the oldest theme park in South Korea and the largest park in South Korea. The Key Worldwide, the world's 5th largest advertising agency, and you can see that this family business is still owned by the descendants of the founder, and it's really hard not even to buy some shares from Samsung Group, but just get a very detailed information about the businesses, strategies, etc. Let us look at another pole of the world. We have a Cargill Incorporated. It is American privately held global food and milling corporation based in Minnesota. It was founded in 2 centuries ago in 1865, and it is the largest privately held corporation in the United States in terms of revenue. That's what we know. If it were a public company, it would rank roughly or the 15th on the Fortune 500. So Cargill has frequently been the subject of criticism related to the environment, human rights, finance, and other ethical considerations. So it's often the case when these private held companies and family held companies pursue very harsh policy in these matters. Some of Cargill's major businesses are trading, purchasing, and distributing grain and other agricultural commodities, such as palm oil, trading in energy, steel and transport, raising of livestock, and production of feed, production of food ingredients such as starch, glucose, syrup, vegetable oil, and many others. So Then Cargill also has a large financial service arm, which manages financial risk in the commodity markets for the company. And Cargill reports revenues around 115 billion and earnings of 3 billion in 2018. It's employing more than 115 employees over 66 countries and is responsible for 25% of all United States grain export. And you know that all eggs used in United States McDonald's restaurants pass through Cargill's plant. It is the only United States producer of Heidelberg processed salt, which is used in the fast food in the prepared foods industry. So probably if you are in the United States and you go to McDonald's, you are eating eggs from Cargill and you're spicing your food with salt from Cargill. And also we have a Koch Industries. It is an American privately held multinational conglomerate in form of corporation based in Kansas. Its subsidiaries are involved in the manufacturing, refining, distribution of petroleum, chemicals, energy, fiber, other intermediaries, and polymers, minerals, fertilizers, pulp, paper, chemical technology equipment, ranching, finance, commodities, and many, many others. The firm also employs more than 120,000 employees in 60 countries. And it is this company is the largest non-Canadian landowner in the Athabasca oil sands. So we also can see that the annual revenues of Koch Industries exceed 110 billion as of 2014. And you know that there is a very curious thing. The company was founded by its namesake, Fred Koch, in 1914, after he developed an innovative crude oil refining process. And Fred Koch died in 1967, and his majority of interest in the company was split amongst his 4 sons. And the company has used its freedom from pressures of public markets to make long-term investments. And Charles Koch has stated that the company would go public over my dead body. It's the son of Fred Koch. So it is also often the case when the descendants of the founders of the family tries to keep the companies private as long as it can, because it provides really good opportunities in comparison to public owned companies. What are the characteristics of these private equity vehicles and private equity investments? The private equity refers to investment in the privately owned companies or in the public companies with the intent to make them private. So finally, the company should become private. As the business conditions and the availability of financing change, the focus of private equity firms may change. A firm may manage many private equity funds, each composed of several investments, and the firm invests in is often called a portfolio company. So remember this term, portfolio company, because we'll have later questions on this term. And it is called a portfolio company because it will become a part of a private equity fund portfolio. According to one possible categorization, we can name the following types of private equity companies: leverage buyout companies, venture capital companies, and growth capital companies. And that definition and categorization closely follows the strategies employed by these companies. So if we talk about the structure and the fees terms, The structure typically is set as a partnerships. We already touched this concept when we discussed hedge funds. Fee is called management fee and can be as 1 to 3% of committed capital. Recall that committed capital is a pledge by limited partners and drawn down as investments are made. And once fully invested, the management fee is based on the funds remaining in the fund as the investment are exited. So if you're draw down all the committed capital, then you make all the investment, your investment are growing, you have more funds under your management. That means that finally your management fee will also grow. And also we have some type of incentive fee that is called in this industry carried interest, and it's usually 20% and is usually not earned until all LPs made whole, means the LPs get their initial investment back. And if we look at this graph, so we can say the private equity activity has grown over time, but it is a cyclical. This table shows the portion of committed capital that has not been yet called, means drawdown. The industry term for it is dry powder. So the powder you can use to shoot. Note that detailed information on this private equity activity is not always readily available, and it is one of the characteristic features when we'll come to the evaluation issues regarding the private equity. If you are not tired with this encyclopedical discoveries, but I want to stress this point and give you a dive for at least for the largest private equity firms, because they are well known and employ various strategies. And also we'll talk about this KKR company because it's very illustrative. Its strategy is very illustrative for the concept of LBO, leveraged buyout, in being. So we have Apollo Global Management, that is a global alternative investment management company. It invests in credit, private equity, real assets, and as of December 2020, the company had 455 billion of assets under management, and this sum has grown 2 times for recent 3 years. So it's all these companies are points of very rapid growth, at least in terms of assets under management. So all these investments are made to real estate, infrastructure, and also in the hedge funds and a mezzanine capital and collateralized loan obligations. The company invests money on behalf of pension funds, financial endowments, and sovereign wealth fund, and as well as other institutional and individual investors since the inception in 1990. Private equity funds managed by Apollo have produced an internal rate of return to investment equals 24%. So you see, over a long period, 24% is very good figure. Apollo was founded in 1990, as I said, by Black, Harris, and Rowan, headquartered in New York City. Among the notable companies in which funds managed by the company have invested, it's CareerBuilder, Cox Media, Intrader, Redbox, Shuttlefly, Smart and Final, and Yahoo. In addition to its private funds, Apollo operates Apollo Investment Corporation. It's a publicly traded private equity closed-end fund and business development company. Apollo Investment Corporation provides mezzanine debt, senior secured loans, equity investment, um, and historically not invested in a company controlled by Apollo private equity fund. So again, this concept of separating your debt and equity arms within the same management company. Let us look at the European market. We have Ardian. It's a France-based independent private equity investment company, founded and managed by Dominique Sinicourt. It is one of the largest European headquartered private equity funds. The company was originally set by Mr. Sinicourt in 1996, and the name of Ardian was inspired by the ancient European language in which Ardian means strength, durability, and boldness. Ardian managed assets worth 113 billion in Europe, North America, Asia. The firm offers fund funds, direct funds, infrastructure, private debt, real estate, and more and more and more. Among these companies, there is a Vinci Park, Luton Airport, and its fund or funds segment own stakes in over than 1,500 funds. So it's a really huge fund. Then we go to Blackstone. Probably you already know a lot of Blackstone. So American alternative investment management company based in New York. In 2019, Blackstone converted from a publicly traded partnership to a C-type corporation, so they go more private. And the Blackstone's private equity business has been one of the largest investors in leveraged buyouts for the last 3 decades, while its real estate business has actively acquired commercial real estate. As of 2020, the company's total assets under management were approximately 690 billion. And Blackstone was founded in 1985 by Peter Peterson and Stephen Schwarzman. They are also from the Lehman Brothers. Then we have the Carlyle Group. It is an American multinational private equity, alternative asset management, and financial services corporation, specialized in private equity, real assets, and private credit. In 2015, Carlyle was the world's largest private equity firm by capital raised over the previous 5 years. It was founded in 1987 in Washington, and the company today has more than 1,500 employees. On May 2012, Carlyle completed a 700 million initial public offering and began trading on Nasdaq stock exchange. What should I say? That there is notable investments of Carlyle, like Ecolite Wines, Booz Allen Hamilton, Dex Media, Dunkin' Brands, Freescale Semiconductor, Getty Images, Hertz, Kinder Morgan, Nielsen, United Defense, and you know that many of, well, not many, but at least a couple of the presidents of United States are known to be affiliated with the company, as here their relatives works in this company even during the term of the presidential term of the President of the United States. So all these companies are really big and they have a good connection with the authorities. And we go to the Kohlberg, Kravis, and Roberts, or now they know as a KKR. It's American global investment companies that manage multiple alternative asset classes, including private equity, energy, infrastructure, real estate, credit, and through its strategic partners, hedge funds. The firm has a total assets under management of 234 billion. Firm was founded in 1976 by Jerome Kohlberg and his cousins Henry Kravis and George Roberts, and it is well known for the earliest leveraged buyout transaction with a high voluminous. And since its founding, KKR has completed a number of transactions, including this transaction in 1989 of leveraged buyout of RJ Arnabisco, which was the largest buyout in history to that point, as well as the buyout of TXU company in 2007. And we will discuss in detail the process of leveraged buyout on the basis of the example of KKR and RJ Nabisco in the next half an hour. So by now I would like to stop, give you a break to have a rest, make a cup of coffee or tea. So please have a 5-minute break, and then we will proceed to the strategy of leveraged buyout. Sorry. Regarding your question about the quizzes, yes, we'll have a quiz after we finish the discussion about the strategies employed by the private equity and the private debt. It will have 9 questions, so probably in an hour or an hour and a half, we'll have only one quiz for today. Okay, let us continue. And we have the leveraged buyout strategy. The leveraged buyout strategy comprises the most of the companies and the assets involved in a private equity. Leveraged buyouts, or LBOs, or highly leveraged transactions, arise from when private equity firms establish buyout funds or LBO funds to acquire public companies or established private companies with a significant percentage of the purchase price financed through debt. The target company's assets typically serve as a collateral for the debt, and the target company's cash flows are expected to be sufficient to service the debt. The debt becomes part of the target company's capital structure if the buyout goes through. After the buyout, the target company becomes or remains a privately owned company, and LBOs are sometimes referred to as going private transactions because after the acquisition of a publicly traded company, the target company's equity is substantially no longer publicly traded. So when the target company is private, it is not a going private transaction. The LBO may also be of a specific type. We have management buyouts, or MBOs. The current management team is involved in the acquisition, and in the case of management buy-ins, or MBIs, the current management team is being replaced and the acquiring team will be involved in managing the company. LBO managers seek to add value by improving companies' operations, boosting revenue, and ultimately increasing profits and cash flows. Cash flow growth in order of contribution comes from organic revenue growth, cost reductions, and reconstructing, acquisitioning, and then all other sources. The financial returns in this category, however, depends to a large extent on the use of leverage. If debt financing is unavailable or costly, LBOs are less likely to take place. So, what is the concept of LBO? You should found the company that is, for some reason, in distressed situation. Its stock price are inadequately low, for example. They have bad management structure, inefficient operations, strong and sustainable cash flow, and still low level of leverage. So not a lot of debt employed by the company. And also as a collateral, it has a significant amount of physical assets. I mean, you have some properties like plants, land, constructions, you can sell and receive a cash. And the idea is to find the financing either through original or bank loans. Then if it is not enough, high yield bonds, that is unsecured in comparison to the bank loans, and also the mezzanine financing that have some additional provisions like equity sweeteners on conversions provisions that provide more attractiveness for this type of financing. And then the buyout fund purchases the company, takes it private, improve management, sells some not needed for the core business, the assets not needed for the core business. Sometimes fire people, sell some not core products or branches, so make the company slimy, tiny, and very profitable, and repay the debt from this cash flow source. So it's very sometimes it's called like money from the air, and the investors in the LBOs is also called like vulture investors, because of this nature of getting the company without paying the huge portion of the acquisition price by your money, instead using the debt. And let us have a dive into this example of AGR Nabisco leveraged buyout performed by the consortium led by KKR. You can see this vulture investors here. It's Henry Kravis here on the left top, and also there is a head of the RGR Nabisco, Ross Johnson, who was a pivotal figure in his buyout, because he was a CEO of the company, and first he opened the gates for these barbarians to enter in LBOs, and then he not succeeded in holding the head position in the LBO, and finally all goes to the Henry Kravis company. So probably you can already acquainted with this case, because a lot of documentational films, books was released. You can see here that it is Barbarians at Gates by Brian Burrow and John Haller. You can check it in the library. Very interesting book. One of those that the investor and alternative investments should have on the table. But let's go into detail. So the leveraged buyout of RGR Nabisco at the time widely considered to be preeminent example of corporate and executive greed. So as already told, the Brian Burrow and John Haller published this book, and it was subsequently the series of television movie on HBO. So what about the key persons? Ross Johnson was the president and the CEO of RGR Nabisco at the time of the leveraged buyout, and Harry Kravis was the managing partner at Kohlberg Kravis Roberts. The leveraged buyout was in the amount on 25 billion, and the battle for control took place between October and November 1988. And although KKR eventually took control of RGR Nabisco, RGR management and Shearson Lehman Hutton had originally announced that they would take RGR Nabisco private at price of $75 per share. And a fierce series of negotiations and proposals ensued, which involved nearly all of the major private equity players of that day, including Morgan Stanley, Goldman Sachs, Salomon Brothers, First Boston, Wasserstein Perella and Company, Frostman Little, Shearson Lehman Hutton, Merrill Lynch. So all the bunch of these sharks on the Wall Street was involved. Once put in play the Shearson Lehman Hutton and RGR management, almost every major Wall Street firm involved in merger and acquisition launched frenzied, literal last-minute bids in a fog of incomplete or misleading information. KKR quickly introduced a tender offer to obtain RGR Nabisco for already $90 per share, a price that enabled it to proceed without the approval of RGR Nabisco management. RGR management team, working with Shearson Lehman Hutton and Salomon Brothers, submitted a bid of $112 per share, a figure they felt certain would enable it to outflank their responded by Kravis. And the Kravis final bid was $109. And while it was a lower dollar figure, it was ultimately accepted by the board of directors. It was accepted because KKR offer was guaranteed, whereas management lacked a third, meaning that the final share price might have been lower than the proposed $112 per share. So again, this very tiny provision in a proposal and the difference in the price of only $3, so it's less than 3% of the total price, was showstopper and the turning point in the decision making. And additionally, many of the RJR boards of directors had grown concerned at recent disclosures of the Johnson's unprecedented golden parachute deal. And the Time magazine featured Johnson on the cover of its December 1988 issue, along with a headline, "A Game of Greed." This man could pocket 100 million from the largest corporate takeover in history. You see it here. KKR offer was welcomed by the board, and to some observers, it appeared that the elevation of the reset issue as a deal breaker in KKR favor was little more than an excuse to reject Johnson's higher payout of 112 per share. Johnson received compensation worth more than 6 million from the buyout, then left in February 1989. You see the result. The CEO received the gold parachute and leave the company. So it's always the key point for such deals to find your people in your person in management. And of course, you should reward him. That it will be definitely highly publicized. In March 1989, the new head of previously head of American Express became a new head of RJR Nabisco. And what was after this buyout? So what's left from this company? On April 27 or next year, the RJR Nabisco announced that it would move its headquarters to more cheap area, and RJR Nabisco divested the following divisions. So United Kingdom operations, France operations, Italy operations was sold. They was finally acquired by the PepsiCo. The Asian subsidiary was sold. The biscuit subsidiary branch was sold to United Kingdom investor. You know the brand Fresh Del Monte that produce that sold the produce from the Brasilia was sold also. The canning subsidiary Del Monte Foods was sold to Merrill Lynch, Citicorp, and finally it was sold to the Kikkoman. It's a brand that produces soy sauce now. And the company's 20% stake in ESPN was sold to Hearst Communication. So TMT investments were also divested. That's how it goes. So on March 21st, 1991, so after 4 years of this acquisition, the Nabisco Holding Corp became a publicly traded stock again. And later, in March 1999, Nabisco announced the sale of international divisions of the tobacco line, and the parent company became Nabisco Holding Group, owned by 80% of Nabisco Holding. And in a year 2000, the Philip Morris bought the Nabisco Holdings. So you see that all this Nabisco, they have initially the many branches, not only the tobacco producing branch, but all they was divested, and finally what rest in a tobacco industry was bought by Philip Morris. So The deal was completed in December 2000. So after 11 years, nothing remains from original RGR Nabisco. That's why it is also this investment strategies often calls vulture investments, or investors called vulture investors. But let us move to the next type, comprising relatively smaller proportion of assets being invested under this strategy. It's a venture capital. And venture capital investing in or providing financing to private companies with high growth potential. Typically, these are startups of young companies, but venture capital can be provided at a variety of stages, ranging from the inception of the idea for a company to the point when the company is about to launch an IPO or to be acquired. The investment return required varies on the basis of the company's stage of development. Investors in the early stage companies will demand higher expected return relative to later stage investors because the earlier the stage of the development, the higher the risk. Venture capitalists, like all private equity managers, are not passive investors. They are actively involved with the companies in which they invest. Venture capital funds typically invest in companies and receive an equity interest, but may also provide financing in a form of debt, and it's often convertible debt. So we have the following stages of financing. Formative stage financing is for a company that is still in the process of being formed. Its steps are as follows. Pre-seed capital or angel investing is a capital provided at the idea stage. Funds may be used to transform the idea into a business plan and to assess market potential. The amount of financing at this stage is typically small and provided by individuals, often friends, family, rather than by venture capital funds. Then goes seed stage financing or seed capital, and generally supports product development and marketing efforts, including marketing research. This is the first stage at which the venture capital funds usually invest. And it follows by early stage financing or early stage venture capital or startup stage financing. And this capital is provided to companies that are moving toward operation but have not yet started commercial production or sales, both of which early stage financing may be injected to initiate. Then the second stage is a later stage financing or expansion venture capital that is provided after commercial production and sales have begun, but before an IPO takes place. Funds may be used to support initial growth, a major expansion, for example, physical plant upgrade, product improvements, or a larger marketing campaign, for example, going for some new regional market. And the last is a mezzanine stage financing or mezzanine venture capital that prepares a company to go public. It represents bridge financing needing to fund the private firm until it can complete an IPO or to be sold, because going IPO can take as long as 5 years. And even if you're prepared everything for IPO, again, some procedures may take about half a year or a year. So immediate procedures on the stock exchanges, but you have to function over this period. So you have to accept the mezzanine stage financing. The term mezzanine stage financing is used because this financing is provided at the stage between being a private company and being a public company. The focus is on when the financing occurs rather than the financing mechanism itself. Formative stage financing is generally carried out by providing ordinary or convertible preferred shares to the investor or investors. Like the venture capital fund, while management retains control of the company. Later stage financing generally involves management selling control of the company to the venture capital investors. Financing is provided through equity and debt, although the fund may also use convertible bonds or convertible preferred shares. The venture capital fund offers debt financing not for the reasons of income generation, but rather for reasons of recovery and the control of assets in a case of bankruptcy. Simply put, debt financing efforts the venture capital for more protection than equity does. And what should we also mention in this venture capital? Then there is a rule in venture capital investment. You better have to invest in a 5-grade management team with a 4-grade idea than to invest in a 5-grade idea but 4-grade management team, because the execution knowledge is the cornerstone of this venture capital investment. So please pay attention to the quality and proficiency of the management team that will execute the venture projects. So to make an investment, a venture capitalists needs to be convinced that the portfolio company management team is competent and is armed with a solid business plan and strong prospects of growth. Because these investments are not made in mature businesses with years of operational and financial performance history, estimating company valuations on the basis of future prospects is highly uncertain. And I can also give some examples from my own experience. Yes, I came across some financial models that later become as the basis for finance provided by venture capitalists, where the all cash flow projections were made simply like, you know, we growth from beginning of the year by 15%. That's good. We have another year of growth, and the growth in next year will be 2 times. And when they ask why you grow only 50% this year and you expect to grow 2 times next year, it's because we will launch our product. And in some cases, venture capitalists trust the management team if they have a trust in the managers. So such a very simplistic, not detailed, vague, and certain models can be a basis for providing a finance if there is a trust in a management team. So the accurate estimations is more difficult than in LBO investing, which targets mature, underperforming public companies. Certainty around valuation increases as the portfolio company matures and moves into later stage financing. But even then, there remains more certainty around LBO investments. And this table takes us through the growth stages of a company and the types of financing it may receive at each stage. You can see here, and we also have other private equity strategies. We should mention it. And among several other specialties, some private equity firms specialize in a growth capital, also known as a growth equity or minority equity investing. Growth capital generally refers to minority equity investments whereby the firm takes a less than controlling interest in the more mature companies that are looking for capital to expand or restructure operations, enter new markets, or finance major acquisitions. Many times, minority equity investing is initiated and sought to be made by management of the investee company, which is interested in realizing earnings from selling a portion of its shares before the company can go public, but still seeks to retain control and participation in the success of the company. So, in this case, these private equity companies serves as intermediary between the management of the company and the future investors in the company if it goes public or expand its operations. And although this scenario occurs most commonly with private companies, publicly quoted companies can seek private equity capital through PIP, that is private investments in the public equities, and other private equity strategies secure returns by investing in companies and specific industries. And what are the exit strategies? So there's another joke or another rule I should mention to you. So you shouldn't be smart to enter the investment. When you should be smart is when to exit this investment. Private equity firms seek to improve new or underperforming businesses and then exit them at a higher valuations, buying and holding companies for an average of 5 years. The time to exit, however, can range from less than 6 months to more than 10 years. Before deciding on an exit strategy, private equity managers take into account the dynamics of the industry in which the portfolio company competes, the overall economic cycle, interest rate, and company performance. Managers pursue the following common exit strategies. The trade sale. This refers to the sale of a company to a strategic buyer, such as a competitor. A trade sale can be conducted by auction or by private negotiation. Benefits include an immediate cash exit for the private equity fund, the potential willingness of strategic buyer to pay more because they anticipate synergies with their own business, fast and simple execution, lower transaction cost than for an IPO, and lower levels of disclosure and high confidentiality than for an IPO, because private equity firms generally deal with only one other party, no public market. But we also have disadvantages of a trade sale that include a possible opposition by management. Management may wish to avoid being purchased by a competitor for job security reasons, low attractiveness to employees of the portfolio companies than for an IPO. An IPO allows for the monetizing of the shares, a limited universe of potential trade buyers, and potentially lower price for the sale that would be achieved from an IPO. And also, as I mentioned previously, you should start thinking about exit strategy before you enter into investment, and that's clearly applicable to the trade sale exit strategy. If you want to exit via trade sale, then you should identify the strategic buyer for your investment before going for this investment. And while you're in investment, you should prepare your portfolio company, for the future inception by strategic buyers. That means the corporate culture, the IT infrastructure, the accounting policies, the product design, product lines, etc., should follow the best practices or applicable standards or existing policies of strategic buyer as early as it can and as closely as it can. For example, many companies, especially in IT sphere, who wants to be then purchased by Amazon, Apple, Microsoft, Facebook, etc., start with yielding the very environment, for example, of Microsoft, having staff policies the same as in Microsoft, integrating their solutions and having the portfolio of clients that is compulsory to Microsoft ones, etc., etc., etc. So please start thinking about the exit before you enter into investment. It also applies to any type of investment, even your personal. Okay, another strategy for exit, an IPO. In an initial public offering, the portfolio company sells its shares, including some or all of those held by the private equity firm, to public investors. Advantages of an IPO exit include the potential for the highest price, management approval, because management will be retained, publicity for the private equity firm, and future upside potential, because the private equity firm may choose to remain as a large shareholder. Disadvantages of an IPO exit include the high transaction costs paid to the investment banks and lawyers, long lead times, the risk of stock market volatility, including short-term focus of some investors, onerous disclosure requirements, a potential lockup period, which requires the private equity firm to retain an equity position for a specified period after the IPO, and the fact that IPOs are usually appropriate only for larger companies with attractive growth profiles. And again, from my own experience, I should mention that it's often the case when the company that's going to IPO and is going for a long period, like 3 to 5 years, at some point decided that, okay, everything is okay, but it is not the right time to go IPO. We should not go to IPO. So we have pretty recent example of this situation in the Russian market. And I also have this example in my experience when we are prepared for IPO starting from year 2011, and we targeted to go IPO in this real estate company called TPS Real Estate in 2016, but then the crisis of year 2014 came to effect, and it was really not the correct point in time to go public. And still this company is not gone public, but trying to do so. We have a couple of strategies left, and we have a rest. So recapitalization. Recapitalization is, in the context of the private equity, describes the steps a firm takes to increase or introduce leverage to its portfolio company and pay itself a dividend out of the new capital structure. A recapitalization is not a true exit strategy because the private equity firm typically maintains control. However, it does allow the private equity investor to extract money from the company to pay its investors and improve IRR. A recapitalization may be a prelude to a later exit, and however, limited partners, investors should be aware that a recapitalization can be used as the methods for the general partner to manipulate IRRs. We have also secondary sales. This approach represents a sale of a company to another private equity firm or another group of investors. With the growth of this dry powder volume, remember the previous slide, we have seen an increase in the proportion of secondary sales exit. And not favorable exit, but it happens. Write-off or liquidation. A write-off occurs when a transaction has not gone well. The private equity firm revises the value of its investment downward or liquidates the portfolio company before moving on to the other projects. The foregoing exit strategies may be pursued individually or in a concern, or may be used for partial exit strategy. For example, private equity funds may sell a portion of a portfolio company to a competitor, to a trade sale, and then complete a secondary sale to another private equity firm for the remaining portion. Company shares may also be distributed to fund investors, although such move is really unusual. So let us have a break now, then we will discuss about the private debt and the risk return profiles of private equity and private debt. Please have a break and we'll come back at 7:50. Okay? If you have any questions, please type in the chat, raise hand. I'm all yours. Okay, let us continue and probably we'll save some time today. So another version of the private capital is the private debt. The private debt is primarily refers to the various forms of debt provided to investors by private entities. In the past decade, the expansion of the private debt market has been largely driven by private lending funds, filling the gap between borrowing demand and reduced lending supply from traditional lenders in a phase of tightened regulations following the 2008 financial crisis. We can organize the primary methods of private debt investing into four categories: direct lending, mezzanine loans, venture debt, and distressed debt. The broad array of debt strategies offers not only diversification benefits, but also exposure to other investment spheres like real estate and infrastructure. Direct lending. The private debt investors get involved in a direct lending by providing capital directly to borrowers and subsequently receiving interest. The original principal and possibly other payments in exchange for the investment. As with typical bank loans, payments are usually received on a fixed schedule, and the loan itself typically is senior and secured and has covenants in place to protect the lender investor. The loan is provided by a small number of investors to a private and sometimes public entities, and it differs from traditional debt instruments such as bonds that are issued to many participants and can be publicly traded in the market. So it's always over-the-counter deals. Direct lending primarily involves private debt firms or private equity firms with private debt arms establishing funds with money raised from investors looking for a high-yield debt. Fund managers will then seek opportunities to deploy that capital, such as providing a loan to a mid-market corporation or extending debt to another private equity fund that is seeking financing for acquisitions. Recalling this case of LBO. In general, private debt funds provide a debt at high interest rates to entities that require capital but lack favorable alternatives to traditional bank lenders, who themselves may be uninterested or unable to provide debt to those borrowers. As in a private equity, private debt fund managers conduct thorough due diligence before selecting the fund's investments. In direct lending, many firms may also provide debt in the form of a leveraged loan, which is a loan that is self-levered. In other words, private debt firms that invest in a leveraged loans will borrow money to finance the debt at the firm that extends to another borrower. So double borrowing, double lending. By using leverage, a private debt firm can enhance the return on the loan portfolio and, of course, increase risks associated with this increased leverage. Then we have mezzanine debt. In private debt, mezzanine debt refers to private credit that is subordinated to senior secured debt, but is senior to equity in a borrower's capital structure. Mezzanine debt makes a pool of additional capital available to borrowers beyond senior secured debt and is often used to finance LBOs, recapitalizations, corporate acquisitions, and similar transactions. Because of its typically junior ranking and the fact that it is usually unsecured, mezzanine debt is riskier than a senior secured debt. To compensate investors for this heightened risk profile, investors commonly demand higher interest rates and may require options for equity participation, so some sweeteners. Mezzanine debt often comes with additional features such as warrants or conversion rights, which provide equity participation to lenders or investors, meaning that they have the option of converting their debt into equity or purchasing the equity of the underlying borrower under certain circumstances. And they will have a venture debt. Venture debt is a private debt funding provided to startup or early stage companies with venture capital backing that may be generated little or negative cash flow. Entrepreneurs may seek venture debt, which often takes the form of a line of credit or term loan as a way to obtain additional financing without further diluting shareholders' ownership in their business. Venture debt can be complemented existing equity financing, allowing shareholders to maintain ownership and control over the company for a longer period of time. Similar to mezzanine debt, venture debt may carry additional features that compensate the investor or lender with the increased risk of default or for the fact that startup and early stage companies often lack substantial assets that can be pledged as collateral for the debt. One such feature could grant the lender rights to purchase equity in the borrowing company under certain circumstances. So some feature of convertible debt. And we have again distressed debt, distressed investing. Involvement in distressed debt typically entails buying the debt of mature companies with financial difficulty. These companies may be in a bankruptcy proceedings, have defaulted on debt, or seem likely to default on debt. Some investors identify companies with temporary cash flow problems, but a good business plan that will help the company survive and, in the end, flourish. These investors buy the company's debt in expectation of both the company and its debt increasing in value. Turnaround investors buy debt and plan to be more active in the management and direction of the company. They seek distressed companies to restructure and revive. And we have a bunch of other private debt strategies like private debt firms may have specialties other than the mentioned strategies, one of which is investing or issuing. Sorry, I have a question. Okay, Luca, no problems with quizzes. We haven't taken any quiz right now, so we'll have quiz after we'll finish about the all things about the private equity and private debt. So no problem with that. Come back to the other private debt strategies. So they can, the private debt firms can issue collateralized loan obligations or CLO, which are leveraged structured vehicles that are collateralized by a portfolio of loans covering a diverse range of tranches, issues, and industries. A collateralized loan obligation manager extends several loans to corporations, usually to firms involved in the LBOs, corporate acquisitions, or similar transactions, pools these loans together, and then divides the pool into various tranches of debt and equity that differ in seniority and security. The CLO manager then sells each tranche to different investors according to their risk profile. The most senior portion of the CLO will be the least risky, and the most junior portion of the CLO, that is equity, will be the riskiest. And we will explore this concept of slicing and dicing of tranches of loans proceeds when we will discuss collateralized mortgage obligations, there was an focus of this subprime mortgage obligation crisis in the United States, 2007, 2009. So these are good strategies, but they embed a very high risk, especially if you cannot get the detailed information for each issue of such a collateralized loan obligation, and especially in the cases when you have a multi-layer of this obligation. So for example, some issuer construct and issue the very first loan that is collateralized by the initial pool of obligations, but then we have a second layer where another issue again pulls already collateralized loan obligations from the first level, slice and dice its tranches, provide additional portions of the collateralized loan, and then again assign some very intrinsic, very specific and complex formula to get the credit rating, and this loan became more attractive as it is by its nature, etc., etc. So we can build this heap of collateralized loans on each other as high as possible until some authority or regulator or rating agency come to the place and say, oh, looks, you want to receive the grade AAA for your collateralized loan, but it should be C or not investment grade if we will calculate the risk profile carefully. That was the case of this subprime mortgage big obligations in the United States. So we will take a dive into this crisis in the next session on real estate. And talking about the private debt strategy, we have another type of debt that could be directly extended to borrowers, is unitranche debt. Unitranche debt consists of a hybrid or blended loan structure that combines different tranches of securities and unsecured debt into a single loan with a single blended interest rate. Since unitranche debt is a blend of secured and unsecured debt, the interest rate on this type of loan will generally fall in between the interest rates often demanded on secured and unsecured debt. And the unitranche loan itself will usually be structured between senior and subordinated debt in terms of priority ranking. Some private debt firms invest in real estate debt or infrastructure debt. Real estate debt refers to loans and other forms of debt provided for real estate financing, whereas specified real estate asset or property serves as a collateral. I already mentioned this, collateralized mortgage-based obligations and others. And infrastructure debt encompasses many forms of debt issued to finance construction, operation, and maintenance on infrastructure assets. Private debt firms may also provide specialty loans where debt is extended to niche borrowers in specific situations. For example, litigation finance is the practice of a specialist funding company providing debt to clients, usually painstaking in a litigation for their legal fees and expenses in exchange for a portion of any case winnings. And we have another type of loans, or even the type of public finance, crowd finance, probably already know it, like providing the capital for companies that are in the process of tendering for state procurement, but they have to pay, put some capital up front, just margin, and they do not have the sufficient capital. So some investors, maybe pooled investors, so crowd investors, or just ordinary lenders provide such a capital in this very specific situation. And if the tender for the state procurement contract wins, so it receive his margin back and repays the debt. So that's the case. Yeah, let us discuss about risk and return on private. I should switch this. The higher return opportunities that private equity funds may provide relative to traditional investments are a function of their ability to invest in private companies, their influence on the portfolio company's management and operations, and their use of leverage. Investing in a private equity, including venture capital, is riskier than investing in a common stock. Investors require higher return for accepting higher risk, including illiquidity and leverage risk. This table here shows the mean annual returns for the Cambridge Associates US Private Equity Index, the Nasdaq Index, and the Standard & Poor's 500 Index for a variety of periods ending December 2019. Because private equity returns are based on IRR, however, it is difficult to identify reliable benchmarks for comparing returns to investments. Published private equity indexes may be unreliable measure of performance. Measuring historical private equity performance is challenging. As with hedge funds, private equity return indexes rely on self-reporting and subject to survivorship, backfill, recall it, and other biases, which typically lead to an overstatement of returns. Moreover, prior to year 2009, in the absence of liquidity event, private equity firms did not necessarily mark their investments to market. This failure to mark the market leads to an understatement or of the measures of volatility and correlations with other investments. So you underestimate your volatility and correlation values. And thus, data adjustments are required to more reliably measure the benefits of a private equity investing. Investors should require higher return for accepting a higher risk, including illiquidity and leverage risk. And if we talk about the investment characteristic of the private debt and its risk return profile, the private debt investments may provide higher yielding opportunities to fixed income investors seeking increased returns relative to the traditional bonds. The private debt funds may generate higher returns by taking opportunistic positions based on market inefficiencies. Indeed, private lending funds stepped in the financing gap between traditional lenders following the crisis of 2008, and investors in private debt could realize high returns from the illiquidity premium, which is the excess return investors require to compensate for lack of liquidity, and may benefit from increased diversification in their portfolios. The potential for high returns is connected to higher levels of risk. Private debt investments vary in risk and return, with senior private debt providing a steadier yield and moderate risk, and mezzanine private debt carrying higher growth potential, equity upside, and higher risk. As a whole, however, investing in a private debt is riskier than investing in traditional bonds. Investors should be aware of this risk, which include illiquidity and heightened default risk when loans are extended to risky entities or borrowers in riskier situation. And the table here shows annualized returns and standard deviations for private debt funds for the period from 2004 to 2016. And based on these figures, private debt funds appear to have an attractive risk premium trade-off. You can see. Although there is no widely used benchmark for private debt, various indexes may serve investor purposes as long as they understand the pros and cons of each index. The ICE, Bank of America Merrill Lynch Global High Yield Index, shortly HIY, tracks publicly traded non-investment grade corporate bonds of large institutional corporations. The LSTA US Leveraged Loan Index, or LLI, covers syndicated and over-the-counter traded non-investment grade loans for large US corporations. The Standard & Poor's Net Total Return BDC index tracks publicly traded business development companies, and the Cliffwater Direct Lending Index CDLI is based on quarterly SEC filings covering more than 60 private and public business development companies. So we also have a variety of indexes, but we should be aware about the biases and that indexes had and the adjustments the analyst should make to assessing the performance of such indexes. And let us have a look at this chart. So investments in a private equity and private debt vary in terms of risk and return because of the various factors, including but not limited to ranking in an entity's capital structure. And this exhibit contains a graph that plots private equity and private debt categories by their risk and return levels, mirroring the risk-return pathway for traditional equity and debt investing. This graph plots private equity and private debt using categories that are broadly similar to how we have defined them. Look, the trade-offs as investors select between junior and senior debt and between equity and debt. So the higher return, so the higher risk you have. And we have this infrastructure debt with the lowest profile of risk and then the lowest return, and the mezzanine debt and the, again, private equity co-investment at the highest level, both of risk and return. Okay. I would also want to present this chart in the discussion of risk return profile and potential benefits. So investment in private capital funds can add a moderate diversification benefit to a portfolio of publicly traded stocks and bonds with correlations with public markets indexes varying from 1.47 to 0.47 to 0.75, as shown in this picture. And if investors identify skillful fund managers, they may benefit from excess returns given the additional leverage, market, and liquidity risks. Private equity investments may also offer vintage diversification because capital is not deployed at a single point in time, but invested over several years. Private debt investment, which offer more options than bonds and public forms of traditional fixed income, can also serve diversification efforts. Ultimately, investors should prudently avoid concentration risk, aiming to diversify across different managers, industries, and geographies. So we have about an hour left, and we have two topics to discuss: this performance evaluation and this phenomenon of J-curve of private equity, as well as some specific methods for valuing the portfolio companies. What I suggest for you, probably it's better for us to continue with a lecture, and I will leave the quiz for you to pass on your own, or we can pass a quiz together with me now, and then we will probably it will take from 15 to 20 minutes, and we'll have a break, and then we'll have a final section for performance evaluation and some specific methods of applying for evaluation. So please say what's options suits you best. The deadline next session. No objections about to continue lecture now and have this quiz for you to pass on your own. And yes, we will check this quiz in the beginning of next session. So is it okay for you to proceed with lecture and have a quiz for home? Please let me know if someone disagreed, because it's very important if we didn't hear someone. Yeah, good. So, very interesting picture. I will provide the link to the quiz. I will launch the quiz after we'll end this session together with you, and write the link to the chat window, and also supplement this link with the letters that I will send after the session with all the slides, etc., etc. So you will be able to get the link both from the chart and from the mail. Okay, let's move on. So we have this J-curve of a private equity. What is this? While I will be explaining, please try to identify for yourself what are the processes that drive the value of IRR for the private equity along with the time passes. So unlike liquid hedge fund strategies, alternative investments that involve private equity tend to have variable cash flows. Private equity investments generally involve an initial capital commitment, but actual capital flows often lag that commitment because capital calls are staggered over a substantive period of time. Private equity returns are frequently described in terms of the J-curve effect. A substantive initial capital commitment promise followed by high initial fee drag calculated on total committed capital, not the capital actually called, followed by identification of longer-term growth or turnaround opportunities, and eventual positive return when the staggered returns of the fund are realized. The component investments mature and are sold at various times, and the partnership finally closes, but usually only after 6 to 8 years, often with 2-year extensions allowed at the discretion of the general partner or after a vote of approval by majority of limited partners. The line representing the return changes from downward sloping to positive and then to energetically upward sloping later in the investment life, if all goes well. So in this stage, you starting, you see my pointer here. Okay, so in this stage you're starting to drawing down the capital. So you have receive capital and investing this in a projects, so negative total net cash flow, but the projects are not paying you well and you're still investing, and at this break-even point you have diminishing in negative cash flows and increasing positive cash flows. So you're starting to um, earn more and more, and at this point you finally get to the um, total sum of cash inflows minus total sum of cash outflows, of course, bring it to the um, uh, period of start point, so taking into consideration the time value of money. And afterwards you experience a period of rapid growth because more and more of your investments turns to be profitable, and the amount, so the volume of the profit increases in time. But then you probably you are exit from some investments, so the number of active investment is decreasing, the investments became more mature, their cash flow stabilized, that leads to a downward sloping curve of this IRR with the pass of time. So please remember this very um, interesting, easy to remember and understand J-curve effect for the private equity. The measurement of success depends far more on the timing and the magnitude of cash flows and out of the in and out to the investment. And these are often hard to standardize, let alone always properly anticipate. Given the long time horizon, the application of different tax treatments can have a non-trivial impact on after-tax investment returns. And it's especially in a case if you invest in some capital extensive in assets and they have some special regime for tax or some tax waivers or moratorium, etc. For example, if you invest in a public infrastructure object or assets, then it's very often you receive some moratorium for payment of property tax. It can be as much as 5 to 10 years. And also you have a very interesting turnover profile for your VAT, because first you have to pay this VAT in the amounts as part of the amounts paid to the contractors. But then you have a very specific procedure for either to account for this already paid VAT or to get it back from the budget as you complete the capital construction projects. But the process of proving and signing completion letters can be very different. For example, if your manager to have signed several series or lines of construction, like to complete construction in lines, it will help you to early receive this VAT credit back. But if you cannot, you should wait for the completion of the whole complex of your capital assets. Then probably it will take a longer period for you to receive this VAT back or to have to be able to use a VAT credit in your tax purposes. So it's again the tax consideration is very different for each product. And there is a general rule: the best way to start evaluating such investment is with the IRR of the respective cash flows into investment and the timing thereof versus the magnitude and the timing of cash flows returned by the investment. And of course, you should include this tax benefit to this calculation. An independent fixed life private equity fund. In this fund, the decisions to raise money, take money in the form of capital calls, and distribute proceeds are all at the discretion of the private equity manager. Timing of cash flows is an important part of the investment decision process. The private equity manager should thus be rewarded or penalized for the results of those timing decisions, and the calculations of IRR is a key metric to doing so. Although the determination of an IRR involves certain assumptions about a financing rate to use for ongoing cash flows, and it's typically a weighted average cost of the capital, and the assumptions about the investment rate to use for incoming cash flows, which must be assumed and may or may not actually be earned. The IRR is the key metric used to assess longer-term alternative investment in the private equity world. Okay, so because of this complexity, a shortcut methodology often used by private equity managers involves simply citing a multiple of invested capital or money multiple on total paid-in capital. Here, one simply measures the total value of distributions and residual assets values relative to an initial total investment. Although this shortcut valuation completely ignores the timing of cash flow, it is easier to calculate and it is intuitively easier to understand when someone says they received 2 or 3 times the initial investment. But how long it takes to realize this value doesn't matter. A 2-time return on one's initial investment would be phenomenal if the return were collected over 2 years, but far less compelling if it took 15 years to realize. And in general, because private equity investing involves longer holding periods, there is a less emphasis on evaluating them in terms of shorter-term portfolio correlation benefits. After a private equity fund has fully drawn in its monetary commitments, interim accounting values for a private equity partnership become less critical for a period of time because no incoming or outgoing cash flows may immediately hinge on such valuations. During this middle period in the life of a private equity fund, accounting values may not always be particularly reflective of the future potential realizations and hence the expected returns of the fund. It is not that the value of the investments is not actually rising and falling in the face of economic influences, rather than accounting conventions simply leave longer-lived investments marketed at the initial cost for some time or make only modest adjustments to carrying value until clearer impairments or realization even took place. Ironically, many investors gravitate to private equity because they're not easily marked to market and can deliver somewhat smooth returns over time, with less short-term mark-to-market angst. Although most private equity managers are conservative in their marks, a lagged mark-to-market process can at times offer a false sense of success, diminishing short-term investment worry about subsequently delivering the occasional back-end loaded investment disappointment. The private equity interim valuations can certainly be inaccurate and skewed at times despite the best efforts of auditors to present a fair valuation. The lagging impact of short-term economic events on the interim accounting valuations of these strategies make them appear more resilient and less correlated than they really are. A more realistic picture may emerge when premature portfolio liquidations are forced on managers. The lack of transparency around such investments and the slowness to mark them to market can be incorrectly construed by investors as an overall lack of volatility. Along these imperfect paths, and in an effort to benchmark how long-term investments may be faring, private equity managers are generally judged by where they fall in terms of quartile ranking, which depicts their performance against a cohort of peers investment vehicles constructed with similar investment attributes and funded around the same time, or what is often referred to as the same vintage year. The larger latitude around carried valuations for private equity strategies makes any application of short-term risk metrics highly inappropriate. Instead, the probability of permanent impairment on an investment is likely the best risk measure. Along these lines, and admittedly backward-looking metrics of some interest and potential value that many private equity managers refer to is their historic capital loss ratio, defined as a percentage of a capital in deals that have been realized below costs, net of any recovered proceeds, divided by total invested capital. Because markets have been generally buoyant for the past 10 years, investors can overestimate the true resilience of the private equity. Having money tied up in longer-lived investments for 7 to 10 years should conceptually earn an illiquidity premium, but may easily result in return disappointment when given the wrong economic environment. Please consider these characteristics of valuation and pay attention to, or please use this application of these principles in valuing the portfolio companies. So this multiple approach, you can use multiple as to calculate your value and calculate your on the basis of your peers. You can have some proxy of the cash flow or proxy of performance of the peer, like EBITDA or anything else like sales, or in some instances it may be some non-money measure like in IT outsourcing or computer services companies. It is often effective to measure the to calculate the value of the company on the basis of the head count if all other things are the same. So you're just multiplying the number of your developers in an IT company by some industry average standard value per one developer, and it will lead you to valuation of your company. But again, your company should be peered with your peers, so it means you should take the initial data and valuation metrics from the company that's very same to your one. Then we have not comparable valuation, but absolute valuation based on the cash flows. We can use the dividend discount model and the cash flow to the firm model. The dividend discount model is very straightforward, while the cash flow Our DCF model generally consists of several parts. Like we have very the first period where we have very predictive cash flows. We can evaluate with these cash flows with a high degree of certainty, and it's also often called like a prognosis period. Then we have some additional period where we just use some simplification model or simple formula like Gordon model or two-stage growth model to calculate the value of the rest of the cash flows, assuming that they will continue in perpetuity. And also you have a different discount rates to measure your cash flow to the firm and cash flow to the equity. And another interesting approach is asset-based approach. When you have the total sum of your assets minus total sum of your liabilities, and that will lead you to the value of the company. It's often used when you cannot certainly calculate or model your cash flows, but you can just have your estimates done for the value of assets separately and liabilities separately. And again, the process of due diligence on what we should focus in selecting our manager for private capital investment. It's only to the quality of your team, and the quality of the management team generally relied on the quality of general partner, because it is not a person, it is a company or it's a team that manage the project. So you should check the experience, its knowledge base, both in operational field and financial field. And if you're work and invest in some specific industry, that this person and this team should have professionals and professional experience in this field. You should pay close attention to the valuation methodology used, taking into account all these biases and the quality of historical data that can be used for valuation. And the last but not the least, please always start your investment thinking from the point when you think not about how to invest, but also how to exit the investment. So that's all for the lecture on private equity. Please type in the chat if you have any questions, or if you have no questions right now, we can then discuss it later on other sessions. We'll definitely have some special session devoted for the review of the course. And now I would like to start the quiz together with you and provide you with a link. So I will start with knowledge session 3. Open navigation, final score. So please try to enter. Here is the link for the room. It will be opened until we start next session, so till next Wednesday. Try to enter this quiz right now if you can. Okay, so it's working. Good. So, dear students, any questions, any feedback, just share your thoughts, what you want probably to explore in details, what your ideas about the quality of the course. Probably we should cover some aspects more thoroughly, or probably in some cases it's too detailed. I'm happy to see and hear any feedback from you. So please just reflect on your expectation and realized results from the course. Is the knowledge is sufficient? The quality of material good or not? The manner in which I present the course is effective for you? Some problems of getting information, hearing me, understanding me, etc. Because we now nearly the middle of our course and we have some issues to correct. It's the right point to adjust our navigation through the course. Okay, so thank you, and I open for any ideas and discussions. So please proceed with course, and I will stop for now. I wish you a good evening, have a rest, and be prepared for the next day. And we will meet your most of you on Saturday in the course of investment project management, and then on next Wednesday on a course of alternative investments. So thank you very much and goodbye.